Are we in a real estate bubble? And more specifically, here in Dubai, a city that seems to reinvent its skyline almost daily, is this explosive growth sustainable? Or to put it bluntly, is this a party that is about to end? We are going to explore that compelling question today. Alright, let's dive into it. The Dubai's property market, a bubble waiting to burst, or a testament to sustainable growth? Let us explore the realities. So, we have all seen the headlines across major media outlets about the skyrocketing sales, the prices, the never before projects, once in a lifetime offers, and so on. Now, it is of course quite natural for you to wonder if this rocket like ascent has solid fuel or it is running on fumes. I have spent many years as a financial journalist, from my early days in print in Indian Express to the fast paced newsrooms of Bloomberg TV and CNBC. And I have to tell you, I was right there in the CNBC newsroom in 2008. I was a young guy, was quite excited, monitoring the global equity markets, including in the US, and then the opening of the Indian equity markets. From 2006 until mid 2007 was a relatively exciting period, but then the subprime crisis hit the world. I clearly remember watching those screens flash red, the collapse of Lehman Brothers unfolding live, the sheer disbelief all around as the global financial crisis took hold. Trust me, it was a nightmare. That kind of experience, seeing a bubble burst in your face, sticks with you. It makes you look at any market exuberance with a very critical, perhaps even skeptical eye. So, today we are going to do just that. We will break down what a real estate bubble actually is. We'll look at some cautionary tales from around the world, because history, as they say, has a habit of teaching us lessons. We'll touch upon Dubai's past market cycles, and then we will put the current Dubai market under the microscope. Are those classic warning signs flashing, or is there something fundamentally different, something more resilient happening in Dubai? Being a real estate advisor in Dubai, whatever I say could be viewed from the lens of conflict of interest, and that most likely I will not share a balanced perspective. I will try my best to give you a deeper insight which will help you navigate this dynamic Dubai market in a much more confident way. I request you to just stick around and let us dive right into it. So let us start with the basics. What do we mean by a real estate bubble? So imagine a balloon being blown up bigger and bigger. At some point, if it is inflated with too much hot air and not enough material to expand, it is going to pop. In real estate, that hot air is when prices shoot up way beyond what the actual economy can support. To measure that, there are economic indicators like people's wages, job growth, and genuine demand for housing. Now, this is usually the phase when excitement and speculation, the belief that prices will just keep going up, take over from sound economic fundamentals. Usually, this is the start of an economic bubble. Now, to understand better, think of an economic bubble like a party that gets a little too wild. It often starts when something new and exciting appears, maybe a new technology, or super low interest rates making borrowing incredibly cheap. This is the displacement phase. Number one, the first phase. Suddenly, everyone wants to get in. As more people jump on the bandwagon, prices start to climb, and that is the boom phase. This is often fueled by a general sense of optimism. When the economy is doing well, people have more money and feel good about investing, sometimes without looking too closely at the actual value. Then comes the euphoria, where prices go through the roof and caution is thrown to the wind. This is the phase when everyone around you is convinced that the market just cannot go down. This is the phase when the uninformed investors enter. They buy at extreme valuations, and those with insider knowledge, the early investors and corporate executives that study market cycles, begin to quietly sell. The experienced investors sense the warning signs and the profit taking period kicks in. This is the phase when the late entrants are so convinced that they ignore the warnings of overvaluation and the market reaching the peak. In my experience, I have seen many investors even making fun of advisors and ridiculing them in this phase. Social media influencers play a big role in making investors believe in this frenzy. And this is why who you listen to on social media could make or break your long term investment strategy. So be very careful. Now, usually once the peak is reached, a small event can trigger panic. So it could be a very strong rumor, sudden interest rate hike, or even a regional war. And then the prices can fall as fast as they rose, leaving many with significant losses. Usually the market tries to correct itself, but any signs of stability are negatively impacted by further panic selling. In real estate, sudden spike in distressed deals is one of the signs of panic selling. Okay, so now a few usual suspects often contribute to this. And this is an important one. Please listen to this one. So, first, super low interest rates. When money is cheap to borrow, more people are tempted to buy property, sometimes more than they can truly afford. And that pushes prices up overall in the market. Then there is easy credit. So if banks loosen their lending standards, so remember the subprime mortgages that were a huge part of the 2008 crisis that just pours gasoline on the fire. And a big one, speculation. This is when people buy properties not really to live in them or for long term rental income, but just to sell them quickly for a profit as prices rise. This is also known as flipping property. This creates artificial demand and prices can go completely haywire detached from any real value. Unfortunately, or perhaps fortunately, depending on which side of the table you are, these bubbles always burst. And when they do, it can be messy. The prices crash, people lose their homes, and it can even drag the whole economy down. That day in CNBC newsroom in 2008, watching the meltdown, it was not just the numbers on a screen, it was a prelude to real world pain of tens of millions of families across the world. So, how do we try to spot them before they turn into a potential crisis? The International Monetary Fund, or the IMF as we know, has a checklist that is quite straightforward and useful to look at. It may be a longer video than you might imagine, but then I think it will be very helpful if you can hear me out. So they stress looking at real house prices, which means prices with inflation stripped out. Because otherwise, high inflation can fool you into thinking there is a bubble. So IMF suggests looking at the price to income ratio. Are homes becoming unaffordable for ordinary people relative to their earnings? Then there's the flow of easy credit. If borrowing is too easy and widespread, it can fuel a speculative frenzy. Another key indicator is the price to rent ratio. So I just spoke about price to income ratio, but this is the price to rent ratio. Both are quite useful parameters to look at. So look, if buying is massively more expensive than renting a similar place, it's a warning that prices might be driven by hype rather than the fundamental value of that property. So I heard something pretty interesting recently. Apparently, experts are now even talking about detecting exuberance. You know, that wild, explosive price growth that just feels unsustainable, often because everyone is piling in, chasing those rising prices. So now coming back to our checklist. So after price to income ratio, the easy credit price to rent ratio, comes the next one. And this is important one. Higher number of vacant properties. If there are too many empty properties, it is clearly a bad sign. Please keep these indicators in your back pocket because we will be coming back to them and referring to them. This video is going to be longer than what you are used to watching on social media, but trust me, it will be totally worth it. So please hang on and Have some patience and hear me out. Now, history is a great teacher and often a harsh one. The US housing bubble of the 2000s is the one most people remember. Low interest rates after the dot com bust, a flood of easy money, and those infamous subprime mortgages created a frenzy in the US market. Prices soared, but when the music stopped in 2006 and prices started to fall, it triggered a wave of defaults and foreclosures that snowballed into the 2008 global financial crisis. There's Japan in the late 1980s, an asset bubble of epic proportions fueled by easy credit and wild speculation. At its peak, they said the land under the Imperial Palace in Tokyo was worth more than the entire state of California. When the Bank of Japan finally hit the brakes, the bubble burst and Japan slid into what is famously called as lost decade of economic stagnation.